Hello, everybody. Welcome to the Fintech Combine. I am your host, Kris Kovacs, and this is the series where we talk with and sometimes about community-based institutions, their digital and business transformation projects, and we meet the innovators, entrepreneurs, and fintechs that make it all possible. On this episode, we're speaking with Jonty Hirsowitz, the founder and CEO of Deferit, about his journey founding Deferit and their new product called Pebble. So if you're ready, let's suit up and get out on the field. Jonty, I'm super excited to have you on the show today. Why don't you tell us a little bit about your background and about your company, Deferit?
Thanks for having me, Kris. My background's not different. I wouldn't say it's super out of the ordinary. I came from a pretty traditional background before I got into this business. So I used to be a corporate M&A lawyer and then transitioned my career into finance. I was lucky that I had a business degree, but that transition was actually quite hard coming from a legal side. It's actually quite hard when you kind of go down one path and then you're trying to look to move to another. But it was actually through that fortuitous change that I met my co-founder working in finance, and we came up with an idea. And this was back in Australia in about 2018. And the idea was essentially, could we create a platform that helps consumers budget and pay for their bills? I should probably also put one disclaimer in here because I'm originally from South Africa. When I say the word bills, Americans think I'm saying the animal, B-U-L-L. So just anyone who's getting confused throughout this podcast, we are referring to B-I-L-L-S.
There you go. So you made the transition. What triggered that transition for you, going from M&A finance into starting a company? That's a big change.
It's a big change. I think, look, my co-founder is very driven by social missions. And I'd say I was very much yearning to try and solve a problem and also have some form of impact. And I think when we connected working, and we were working at a trading firm, and, our compensation was great, and like the path was before us. I think we both were yearning to do something a little bit different, try and solve a problem and have a bit more of an impact. And I think the allure of that kind of got us off the beaten, like off the most trodden path to, maybe a little bit going down a different route. But I would say that was probably the big drive. And I would say most entrepreneurs probably experience that to an extent as well. And that's what kind of like drives you to go down this route, because at the end of the day, it's probably not the most rational decision when you look back. You have to kind of have some sort of like passion or something that's really driving you down that path. But right. Yeah, I would say it was probably that.
Did you go looking for an opportunity, or did you find an opportunity and said, you know what, this feels better?
Yeah, so it's really interesting. On the original business, which is Deferit, which we started in Australia in 2018, we essentially created a buy now, pay later, but specifically for non-discretionary spend. And the reason, I guess, that's very differentiated to the Afterpays or Klarnas or firms in the market is we don't create new debt for the consumers like they do. So their goal as a company is to try to create incremental order value at checkout. It gives merchants more sales. Our product takes an existing obligation. The customer has to pay it with or without us, and we help them budget it. And the truth of the matter is both my co-founder and I came from backgrounds where we could afford to pay our bills, but we noticed the gap in the market. And through a lot of research, we thought we could help consumers. The Pebble product, which is a new product we introduced in the US, is actually a product that I experienced as a kind of coming to the US from Australia, a problem I had on the credit score. And so that was probably a little bit more personal, and like I saw the opportunity based off a problem I personally kind of had. So that's, I guess, the two differentiators. But in both cases, I think it's very important to look to solve a problem. It's obviously, if you've experienced the problem, you might have a little bit more insight into it, but it's not kind of fully necessary, I would say.
What was the problem that Pebble solves for people?
So I'll just tell you my story, Kris. In Australia, I have a good credit score. But the funny thing is most Australians know their credit score. It's not a system as in the US. And so I moved across to launch the Deferit business, and I come into the US, and I don't have a credit score. And the problem is it's kind of hard to go from 0 to 1. And the only thing that got me across the line was I had an American Express in Australia, and American Express in the US was able to recognize it and gave me the card and gave me the first credit card I had. But I remember I went to all the banks, like it was Chase, all of them, and basically no one wanted to give me the credit card because I had no credit file. And so it was incredibly difficult to go from like that 0 to 1. And what I didn't appreciate at that, so I managed to get into the system, and then obviously I built my credit score up from there. But what I didn't appreciate was how many consumers are thin file and don't have good scores. And so I guess for them is, if you can't access a traditional finance product in the market, it's incredibly hard to start building up credit history. And it's kind of a self-fulfilling cycle. If you can't access the product, you can't build the credit history, you're more prone to using products that aren't as good for you. So once I kind of experienced a little bit of that, we saw that problem and we were like, okay, there must be a way to try and fix this and help consumers build their credit if they're doing the right thing. And what would that look like?
So what does that look like? How does Pebble help a consumer thicken up their credit file?
So Pebble's essentially just a product which takes a form of payments and specifically around bill pay, which is our area of expertise. And it looks to, if a consumer is doing the right thing and paying their biller on time, it essentially looks to report those payments to the credit bureaus to try and give them a little bit more data into their file to help them build some more credit history. So it's essentially a reporting tool to help people build their credit off payments that otherwise don't go to their file.
So a young person who pays their electric bill on time, pays their rent on time, pays their car insurance on time, but doesn't necessarily have credit, this gives them the ability to build credit.
Correct. It allows them to take, the analogy I like to use is, and it's kind of interesting because most of the providers in, say, the utility space or the cell phone space, when you make on-time payments, they don't report. But if you go into default and then you go all the way down arrears with them, at some point at like day 180 or whatever, they will send an adverse report. Some, and some don't, but some will send an adverse report. So it's almost like you get the stick, but you never get the carrot. And so what we like to say is this product is, if you're a consumer and you turn in your homework on time, which is essentially by paying that bill on time, get some form of credit for it. And that's what the system's looking to kind of achieve.
Yeah, I heard you say that for the first time a couple of weeks ago, and it really just stuck out to me. You're so right. If you pay your bills on time, you get no credit for it. But the moment you lapse, man, now you're going to get hit negatively for it. So that really was great insight. Was it? So talk a little bit about, you have Deferit, you're coming to the States and you encounter this new problem. How did you make the decision to introduce this new product when you already had a startup going?
Yeah. So essentially for us, and it's interesting, we have a core bill pay and bill budgeting platform. So we have hundreds of thousands of users coming through that platform. And what we basically had was a testing ground to see, do people want it? Do people need it? And does it work? And so I guess we had the infrastructure to kind of iterate with an existing user base to see what it would look like and how it would work. And I think that was the primary difference than just starting that product off from from a cold start. But what's interesting is the product has become now a separate, fully separate product from what our consumer product is. And it's really built more for enterprise partners in a B2B2C fashion. So whilst we used the know-how and knowledge from the consumer business, we built this product to be a fully separate kind of journey and product, not kind of connected. But we do use it I guess our Deferit business is a partner of the product. I mean, it's obviously 2 affiliates, but we use it in our internal budgeting platform for customers as a kind of a customer. And we get a lot of insights from that as well.
So Deferit is a direct-to-consumer solution?
Primarily direct-to-consumer. We do have some partnerships in that space, but essentially for the consumers that are coming through into that platform, Pebble's essentially an embedded credit building tool. We embed a credit reporting tool into the platform, and customers can use it to build their credit as well.
Talk a little bit about that difference, right? The difference between going direct to consumer and going through business partners, right? How did you have to approach the business differently to make that change?
So the product's got to be built from a completely kind of different lens. For this sort of product, I think it's more, there's a lot of stuff around. Firstly, if we get in a payment data around a payment that's being made, we want to make sure the payment's actually being made. So as a pure direct-to-consumer solution, there's a bit of issues there. If it's coming through, say, a credit union as a post-confirmation payment, or the credit union passes the data, we know for a fact that the transactions happen and the data's there. So there's the aspect of that, but inherently the tool was never built as a kind of a customer-facing straight-up tool. It's meant to be embedded in a workflow and as an add-on. And it's the purpose of the tool is to, one, help the consumer, but also to enrich the environment of our partners, which would be a bank or credit union.
How does the credit union participate in this? What's the business model look like for them?
So the business case is essentially, and I'm not sure, Kris, how familiar you are with it, but essentially there's been a huge shift in bill payment behavior and volumes over, I'd say, the last 10 or 15 years. And what we now are seeing is a lot of consumers are going biller direct and paying their bills directly on biller websites. And there's been a reduction in volume, and it's across all platforms and across all banks. They've been struggling to, like, every bank offers bill pay because it's kind of table stakes, but the volumes are going down and it's a tricky kind of area. And so our value proposition is, number one, we have a lot of data showing that the core demographic, which credit unions and banks really care about, which is about the 25 to 45, they really over-index with this product, and they tend to use it more and more over time. So it can potentially bring in a new segment into that environment, which is important because you want to try and encourage new people to use it. But it also creates a hook, which it gives the customer the ability and the functionality to actually use the bank bill environment rather than biller direct, because it's got a value prop that biller direct doesn't have. So the model really is, it can be embedded in various workflows. It doesn't really interfere with anything. It's just an opt-in from the consumer that they want the payment to get reported. And we have different integration options, either through a partner or it can be done direct, but generally we prefer partners. And from there, essentially, we then also have a full marketing team, which helps with communications for different segments based on who the bank wants to attract. So we have a whole bunch of value props around, if the bank really wants an action of like everyone to go into auto pay, we'll figure out a full campaign to encourage people to enroll in auto pay. And when they do that, they can enroll in the credit building as well. So that's the business case for the institution. And then the model is, we generally have a subscription on the consumer side to be enrolled in the program. And that can be done a couple of ways, where the bank or the partner can try and shoulder most of that if they want to. But we also have rev share back. So it creates a new revenue opportunity for the partners as well.
So theoretically, as you're sitting here talking about it, Jonty, I got this idea that, I mean, theoretically, an institution could come out with a credit builder checking account, right, that has the member opt into reporting all of these recurring payments, right? And when they're identified, because we can identify those, right? We see them come across. As they're identified and reported, that then helps build up the member's credit through their everyday spending, but their recurring bills that are maybe going through either their bill pay or going through their debit card. Yes?
Correct.
Yeah. I think did I just give that idea away?
No, that's I guess that's the execution, right? So there's multiple points you could execute. That's one form, right? So it's whatever way the bank wants to kind of that's like an implementation thing. Do you want it on the checking account? Do you want it as someone pays the actual bill? So like there's multiple options where you can, like, the system's agnostic, But that's where we work in the journey part of what works and what the partner wants, essentially.
So how does this? You talked a little bit about how the 25 to 45-year-old is really subscribing to this concept. Can you talk a little bit more about the research you've done into how this can attract new members to an institution?
For sure. So when we did our research and we tested this in our own platform, we offered it across to different cohorts. And the cohort that it seemed to resonate the most with and it over-indexed compared to the other cohorts was the 25 to 45. And so what we then also noticed was that cohort tended to come back more and more to try and use the product. And from conversations I've had with all these credit unions and banks, that cohort of the 25 to 45 is the tricky one because they're not really using the bank bill pay. But in reality, it's not even an issue of using the bank bill pay. I think all these credit unions and banks, what they really want is engagement. And you want the customer coming back into your environment and engaging with you and coming in that sense. And so the tool, we have the data to show that the tool achieves that. It gets people to not only use it, but they tend to come back more and more, and it creates more of that engagement. And I guess that's one of the big value props for all these institutions. This is a segment which it's the growing segment. It's not really being serviced at the moment, and this is a one tool to kind of encourage it a little bit more.
How much can, if I'm a young member, let's say I'm 25 and I'm participating in this, how much can my credit score move? Right, it's not going to take me from a 520 to an 800, right? So no. I guess in a thin file, I probably don't have any score at all. How much do you think this helps move or kind of add to the development of the credit score for the consumer?
Yeah, so we've done studies. So we took a subset of customers as samples, and we've tested it over time, and it's been very, very interesting. On average, the type of customer that uses us, I think we did it on the Vantage score. The Vantage score was around the 530 or 550, something around in that realm. So the average customer, that's where they were kind of coming in. That's where the demand was the highest as well. And what we then noticed is if they used it for about 3 months or more, we saw an average shift in credit scores of about 30 points improvement in the 3 months. And then obviously the more you use it, the more it goes up. There's obviously a small sample where we saw a little bit negative. I think it was like 2 or 3%. And that's because they've had some adverse thing where they didn't pay a credit card. So the thing's not a panacea to fix everything and everything. It's for like a responsible youth. But on average, a 30-point increase, if you're at 600 and you're going to 630 or 640, it's fairly fundamental if you're applying for an auto loan or something else because it can save you thousands and thousands of dollars in interest. So that's kind of the impact. It's meant to just be a tool in the toolkit. It's not a thing that takes you from 600 to 800, but it's a tool that gives you that feedback where you see it going up slowly over time, and it encourages the use and it encourages good behavior.
How can a credit union, or is there an opportunity for a credit union to pilot or to see what the potential impact could be? Is there any opportunity that you guys offer them to test drive this?
Yeah, so we're very flexible. We have different ways of like integrating, and we have very low touch methods where there's not actually a lot of integration work, right? It's just like it could be an opt-in, and then most of the data handling can be done in the back end without even building APIs. And we have a system to kind of help with that. But essentially what we like to say to a partner is, firstly, what do you care about? So this goes back to solving the problem. And so based on that, we'll work out metrics we want to try and solve with them. So if it's trying to get more volume through bill pay, which shows that it's increasing usage, that could be one metric. The other metric could be the number of returns or monthly active users for the segment they were trying to attract back into their ecosystem. It could be customer satisfaction, that they really appreciate that the partner it's taken an approach to actually help them, and it's strengthened that brand loyalty to that institution. So we would set up metrics and agree on metrics we all care about at the beginning. We would set up the pilot where everyone can kind of test it. And then 3-4 months later, you get the feedback from the customer base, and the credit institution or bank has the ability then to say, like, actually, this thing is fantastic. We want to roll it out, or actually, we want to change it up a little bit. But that's kind of how we approach it. But it's just very important to align on like what we're trying to move, and also then properly making sure the customer gets to that point in the journey so they can actually become aware of it, or they do the marketing around it.
For entrepreneurs that are out there thinking about kind of a product that requires integration versus one that is delivering a specific, consumer experience, right? How did you approach the design and delivery of the solution differently because of what your vision was for it being an integrated solution?
So invariably, like the best design for it is for it to be almost kind of like, I wouldn't say hidden, but like essentially there's no hoops to jump through. And what's interesting is running a consumer business, we have a whole consumer funnel and we've learned a whole bunch about that. The beauty of this product is the end result could just be a kind of a call to action of like enroll. And to your point, it could be then all future transactions on the checking account or anything that goes through the bill pay will then come to us in the back end. The consumer doesn't need to worry about it. And the PII could even be passed by the institution to us. So there is a solution where it's essentially just an embedded tool with a toggle yes or no for the customer. Super seamless, no friction. And then from there, there's a lot of marketing around it to that customer to reinforce the value and then drive the actions that everyone wants to get.
Was that change intentional, moving from a consumer-facing one to this because of the perceived barriers?
Listen, all I'll say is, and I think credit institutions would know this, direct to consumer is hard. It's a hard game, and it's hard with the funnels and with the marketing and with the competition. So we didn't really have the interest of spinning up like another consumer business. What we really wanted to do was we saw, okay, hey, we see a really big problem in our user base. This tool is very well received. We want to offer this tool to partners if they want to use it. It's fully an integration with them. Their customers can use it, and we don't have to do consumer journeys or that, because it's not really built for that. It's just meant to solve a problem in a partner's ecosystem.
So you had to, I mean, there's not a lot of this out there. You had to go to the credit bureau and figure out how to work with them to do this reporting, right? Talk a little bit about some of the administrative or regulatory hoops you had to jump through, and your how you solved that problem as you were developing the solution.
For sure. I think, so what I would first say is there's a lot of credit building products in market. No one's focused on it as we've done it now through like with the specific focus on bill pay. But there's a lot of credit building products in market where and this is kind of saying it in a very basic term, they're looking to game the system. They create these sort of artificial products where you're building credit, but like there's no real like risk in the transaction and the whole, like it's fully gamified. And what generally happens with those products is eventually the bureaus realize, and either they ask them to stop reporting or they just discount the data they furnish into the bureaus. For us, what we did was we went and had conversations with all three major bureaus. We got from them, cool, what are your requirements? What do you need? And there has to be some form of risk in the transaction. That's the common denominator across all the bureaus. And from that, we started devising, okay, the ingredients of the product. So one, we will only do stuff where the underlying payment has a creditor relationship. So you've received a service, you have to pay it after the fact there was risk in the underlying transaction. But then we go further and even over and above it. And I mentioned we have a subscription fee. We take risk on that so the customer doesn't have to pay that up front. And we further overlaid risk into the transaction to make sure there is that requirement that the bureaus are kind of happy. And we wanted to make sure that the product, we take the view of like, do everything by the book and do it right, because in the long run, that will get you to the end zone that you want to go, and that will give you the moat. So that's why I'm also very clear with partners. You have a lot of credit building tools that are like, oh, this will take you from 600 to 750 or 800. In reality, if you're doing it properly, it should never do that. It's for incremental improvement, and it's for helping the customer, and it's kind of doing the right thing and we see the credit bureaus as part in right as well, and making sure we furnish in stuff that actually has value and meets their requirements. So there's that aspect. And then also, look, the biggest thing with credit furnishing is if customers have questions around it, there's all obligations around responding and doing all that, and that's all subsumed, and we handle that in the platform. And so that's part of the service. So the partner never has to worry about dealing with any of that, and that's fully dealt with by us. But yes, it was a process. It took like a year and a half, 2 years to like kind of make sure all that got to the point where we needed it to be.
So as you're thinking back about the journey, right, from where you started to defer it and, the new service Pebble, what advice would you give entrepreneurs who are maybe sitting in a job that, like you, okay, it pays well, but I'm not necessarily fulfilled by what I'm doing, and they're looking for that spark of that opportunity? What advice would you give them?
So this is probably a little bit counter advice, but I would also, because most people say follow the passion, you have all these like Instagrammable quotes. I'm very pragmatic. So my view is I think you should work for someone before you start something, because I think it gives you perspective, or you have some form of life experience where you've done something or gone through something. So working in a big corporate, it does have value. You learn how big corporates work, how processes work. And yes, it may or may not be for you, but it gives you a foundation. And I think that's important for two ways. One, if things don't work out, and there is a high probability, I mean, we're now approaching year 7 or 8 and we've made it over the months, but if it doesn't work out, you have something you could at least go back to. So mitigation there, which not a lot of people talk about, is they all say go full in, don't worry about it. But
Burn
I think it's
boats. Yeah. Right.
But I don't think it hurts to have some life experience behind you. And then it goes back to, if you really want to do something, try and solve a deep problem and deliver value by solving that problem. And it's invariably going to be hard, because if the problem exists, it means no one's really solved it. And you need to be prepared to kind of go in and face a lot of headwinds until you make a little bit of progress. But if you have a bit of experience, you've done the right thing, and you're going after a really good problem that needs to be solved, and you execute well, then yes, it can be absolute green pastures before you. But yeah, essentially it's a cognitive decision you have to make, and it's also a very difficult journey, especially in many of the early years.
Mm-hmm. And Pebble came out of your original idea, right? So there's Deferit, and then the iterations of work that you did in your own experience, right, kind of delivered this new opportunity. So there's an iterative nature to delivering this kind of solution over time.
For sure. And even if you ask me, Kris, we started this business in 2018, and then we expanded and brought it to the US. I never thought I'd be in the US like when I start, you know what I mean? So like there's so much iteration that comes from when you start something that you just never know, I guess, where it's going to land. So that's the lovely thing about business. And then there's obviously competition, and you got to respond to competition. But it's such a journey that to your point, you need to be very flexible. And when you see good things pop up, you need to be able to recognize them and respond and change direction as you need to.
So what changes do you see in the industry now that you're thinking about in your next iteration of Pebble, right? In your next version, your next iteration, where do you think it's going?
So I think, it's interesting. There's a whole bunch of like new alternative data, which is now becoming a little bit of a focus. And I think there's going to be there's a whole thing around open banking, which I'm sure you kind of follow in it from the regulatory side in the US, where everyone's disagreeing on what that actually looks like. But I think what everyone's really fighting about is the cash flow underwriting data, which is pretty pivotal and quite valuable data. And I guess what we see is this product is just kind of a subset of that. It's taken some of the customer behavior, but instead of using it for underwriting or for a purpose that you're looking to kind of monetize it, it's actually taking that data and using it to help the consumer build a better life for themselves by getting them to a little bit of a better spot so they can access better financial products. So for us, anything around that mission of doing that data and providing more access to the customer for these sorts of products which they need would be in our wheelhouse. But at the moment, we just very much focused on making sure the integration options are seamless, that the core key metrics for partners are being achieved. And then from there, I'm sure things will develop and iterate. But that's kind of where I see the trend in the future going. It is going down this whole alternative data point of view, and there is a bit of a tussle on who wants to own it, but I don't think we really getting involved in that. It's more taking the subset of that around the bill payments and what can we do to help the consumer with that.
Right. Jonty, if a credit union or a community bank is interested in reaching out and having a conversation with you, how do they reach you? How do they get in contact with you?
They can just shoot me an email at jonty@deferit.com. We could have a conversation.
Sounds good. Sir, thank you very much for joining us today. A really incredible story, and appreciate you sharing it with us.
Thanks for having me.
What a great conversation with Jonty. Thank you very much for being here today. We really appreciate your support. Please like and subscribe on your platform of choice, and we will see you next time.